How do you pay yourself when you have a single member LLC? I get this question all the time. You want to do it right. You formed your LLC and you want to make sure that you are paying yourself the right way, but how do you actually do that? Keep watching to find out how you actually pay yourself from your LLC. Before we get started, make sure you hit the subscribe button and the little bell so you'll be notified the next time I release a video on how to legally protect your business. Hey, I'm Amy. I'm a lawyer and I've helped hundreds of online business owners form and run their LLCs the right way so that they can grow their business with confidence. When it comes to paying yourself from your LLC, people seriously overcomplicate this. It doesn't have to be complicated. There are two basic things that we need to look at, and then you'll be good to go. The first thing is that you need to pay yourself in a way that makes sure that you are maintaining that legal separation between you and your business. And the second thing is thinking about taxes. But the way that we address both of these things depends on your tax status. A single member LLC can be taxed in a few different ways. So you can be taxed as a sole proprietor, as an S Corp, or as a C Corp. If you haven't chosen any particular tax status for your LLC, then you are taxed as a sole proprietor. That is the default tax election for a single member LLC. If you chose S Corp election, if you made the S election for your LLC, paying yourself does get a little bit more complicated. So we're not going to talk about that today. Today we are just talking about single member LLCs that are taxed as a sole proprietor. So let's take a look at that first piece, which is maintaining the separation between you and your business. So the whole reason that you formed an LLC for your business is to create this legal wall between your business assets and your personal assets. But if you aren't actually treating your LLC as separate from yourself, then that legal wall can go away. A court can decide that it's actually a fiction and you and your business are not separate, and this is called piercing the corporate veil. So we want to make sure that when you're paying yourself, you're not doing it in a way that makes it look like you're just treating your LLC as your personal bank account, your personal ATM. So the first step, and something I hope you have already done, is to make sure that you're maintaining separate bank accounts for your LLC and for all of your personal money. So you should have already set up a business bank account for your LLC using your LLC's EIN number. And if you haven't done that, go do it right now. But if you have that business bank account, all of your revenue from your business should be going straight into your business bank account. None of it should be touching your personal accounts until you do this paying yourself process. Now, the mechanism, the actual way that you get the money from that business bank account to your personal bank account doesn't matter. People get hung up on this, but it doesn't matter how that transfer happens. It could be a check, an ACH transfer. If your bank accounts are in the same bank, you can just move it over. You don't have to use a payroll company because there's no taxes tied into your individual paycheck, and we'll talk more about that a little bit later. But you don't have to use a payroll company or any specific tools to make that paycheck. You just get that money however you want from that business account to your personal account. The actual method of moving that money does not matter. The frequency also doesn't matter, although I do recommend having some kind of schedule so it's not just random days. You could have that be, every Friday, once a week, once a month, I do the 10th, 20th, and 30th, so it's on a regular schedule, but not necessarily consistent day of the week. So as long as you have some kind of schedule, it could even be quarterly. I wouldn't want to go that long without a paycheck, but that's you do you. So the frequency doesn't really matter as long as you have some kind of schedule in place. The only caveat to this is that your operating agreement might have limitations on how and when you pay yourself. So that's pretty rare. So just take a look at your operating agreement and make sure that it doesn't have any restrictions on how often or the actual mechanism behind how you pay yourself. But generally it's not, but just take a look just in case. What's actually more important than the method or the schedule is your thought process, your decision making behind how you pay yourself. Like I said before, you don't want it to look like you're using your business accounts as your personal ATM. So you shouldn't be taking money out whenever you need it or whenever you feel like it. So you should not go in there and grab an extra $100 because you want a nice dinner this week. It's got to be on a system and on a schedule. And making sure you have that system and schedule makes it easier to prove that there is that legal wall of separation between you and your business, and keep that asset protection, which is the whole reason you formed the LLC. Okay, so what should that system be, and how does that relate to how much I pay myself and when I pay myself? What does it all actually look like? My preference here is the Profit First system. It's a book by Mike Michalowicz, Profit First. I highly recommend it. Go out and get it. I'll link it below in the comments. You can buy it on Amazon. It's not an affiliate link or anything. I just really like this book. I think it's a great business tool. So the system that I use for deciding how much to pay myself is the Profit First system. The basic idea is to break down all of your business revenue into percentages. So our revenue can fluctuate a lot month to month or week to week, and so it's helpful to use percentages because then you're not relying on a certain dollar amount for your paycheck that, could be way less one month and way more the other month. So the way this works is that you break down your revenue into 4 buckets, basically. So the first one is going to be profit, and then owner's pay, taxes, and expenses. You then assign percentages to each of these buckets so that every time you look at your revenue for a given period, every week or every month, you can look at it and say, okay, so this percent is going towards tax savings, this percent is going to be my paycheck. And you can break it down that way so that you have an easy way of seeing, how much goes into each category, and you make sure that you're saving and you have enough for your expenses. So you can decide these percentage by looking at your historical revenue numbers and just figure out, what your baseline is. Like on an average month, how much have you spent for expenses? How much has been left over to pay yourself, pay taxes, and save for profit? And you want to make sure that these percentages are realistic based on your historic spending numbers, just so that you can adjust them as you go forward and your business grows and the amount you need for expenses changes. Then every week or month or whatever period you chose, you look at all your revenue from that period and you break it down based on these percentages that you decided. So that let's say 5% for profit, that goes into a profit savings account, and then every quarter you can take that as a little bonus for yourself. And then let's say you're paying yourself 30%, so you take that 30%, transfer it straight into your personal bank account, write yourself a check, whatever you want to do with it. And then you should be saving for taxes, obviously, so that would probably be around 15%. And that goes straight into a tax savings account, and you don't touch it until you have to pay your quarterly taxes. And then the remainder you can pay your expenses with it or transfer it into a specific expense account. And so you have basically every dollar in your business, it's broken up and it has jobs. So every cent that comes into your business has a specific job, and you can assign it based on these percentages every period. If this is making sense so far, let me know in the comments. If you have any questions about that legal wall separating you and your LLC, let me know in the comments. I'd love to hear from you. All right, so I brought up taxes a little bit, and now let's go a little bit more into that. When you use this Profit First system and you divide your revenue into buckets, you can make sure that you're saving for taxes. Because here's the thing, as a business owner, no one else is making sure that you're paying taxes for you. As an employee, you get a certain amount taken out every single paycheck, and that goes straight to the IRS, and that's why you might get a refund, or you only have to pay a small amount. But as a business owner, you're responsible for paying your taxes quarterly. Most business owners have to pay quarterly or annually, and you have to make sure that you are saving enough to pay that bill when it comes due at the end of the year. Now, something that I see people get confused about is what number actually gets taxed. So some people think that what gets taxed depends on what you actually move from your business accounts to your personal accounts, because that's your paycheck, right? So you're taxed on your paycheck. That's not right. So in the eyes of the IRS, your LLC doesn't exist. So I know that's confusing, but a single member LLC taxed as a sole proprietor is considered a disregarded entity by the IRS. So they don't even look at it. They look straight through it. And they consider all of the revenue that you brought into your business as your personal money. And it goes straight onto your personal tax return on your Schedule C. So what you're taxed on is actually all the revenue from your business. And the IRS doesn't even look at how much you actually transferred from your business bank account to your personal bank account. So based on taxes, this paycheck that you give yourself doesn't matter. What matters is your actual revenue and actual expenses in your business. So they tax you on basically your profit because you'll be able to deduct a lot of your expenses. So that's why it's a good idea to take a percentage of your total revenue, completely unrelated to how much you actually pay yourself, and save that in every single period that you're distributing any money from your business. Okay, so that was how to pay yourself from your LLC. The basics are maintain that separation, legal separation between your LLC and your personal assets by having a system and a schedule for how you pay yourself from your business. The mechanism and what that schedule is doesn't matter as long as you're consistent in your decision-making process and have a regular schedule that you stick to. And second piece, make sure that you are saving for taxes because no one else is going to make sure that you do that except for you. So make sure every time you pay yourself a paycheck, you also move money into a tax savings account. If you want to learn more about how to create and run your LLC legally, make sure you watch my free masterclass. The link's going to be in the description down below, all about how to legally protect your online business. If you enjoyed this video, please make sure you hit that like button and subscribe and hit the bell so you'll be notified the next time I release a new video on how to legally protect your business. And if you want to learn more about S-Corp election, like I mentioned at the beginning, watch this video next. Thanks so much for watching, and I'll see you next time.